I think the Fed is not done. I think the Fed will raise rates in July, and there's not a lot of people are talking about the CPI report. The inflation data is actually going to start to have easier comparisons versus last year, which could start to see that lift. And I've had two things on my mind. Either inflation is not going to come down fast and hard enough, or it's going to remain sticky and then possibly start to reaccelerate. And the Fed has a mandate to control inflation, and having the equity markets go higher is probably not in their best interest for their mandate for what they want. And they need a recession to happen to really knock out inflation. And that seems like the waiting for Godot. Nobody's ever going to get a recession. It's never going to happen, but it will probably happen. I can't tell you when, but it's probably on the horizon. And considering the market's gone up so fast, so steep, I wouldn't be shocked to see some sort of significant break in the market.
On today's episode of What the Finance podcast, I have the pleasure of welcoming on Thomas Thornton. He's the president at Hedge Fund Telemetry. So, Thomas, thanks so much for coming on the podcast today.
Thanks for having me. Great to meet.
No problem. Yeah, and I'm really looking forward to our conversation because, I think a lot of the calls you got very correct in 2022. But I know this year you've been talking a little bit about maybe a hard landing and there's going to be a lot of pain moving forward. But it's not something that we've really seen in the markets. And I guess probably most people are thinking that maybe Powell's done it. Maybe he's got that soft landing and we're all going to be okay moving forward. So I guess in your opinion, what are you currently seeing? And do you think that rhetoric's correct or will we see a hard landing? What are your thoughts?
Well, there's nothing that will basically make someone look stupid when you underperform the market, which I am underperforming the market right now. I speak to a lot of different hedge fund managers and long only managers, and they're underperforming the market because they can't overweight the main stocks in the market that have led and done all the heavy lifting. So it's a challenging year for me. I look at it like the year is half over, and um, I still have six months to prove myself. But yeah, last year was a great year. 2021 was a great year. I mean, I generally have pretty decent years. This one hasn't been that easy. I haven't been able to get all of the indicators that I tend to use to line up to create, really what I do. And I'm not one that chases market bubbles. And I think the market is, well, the indices are more or less in a bubble. I think that stocks like Apple, Amazon, Nvidia, Tesla, they're really stretched right now, and they've been stretched. So I'm not going to, I don't hide from saying, yeah, I've been wrong. But yeah, it's getting a little bubblish, and I've been through a bunch of cycles, and I've seen a lot in my career where markets get overextended. They keep going, and then all of a sudden, it's like the music stopped and everybody's scrambling to figure out what to do next. And it's not necessarily just going to be a straight up, Eiffel Tower up and then down. But history has shown that when you have this type of parabolic activity and market sentiment gets so extreme, you should see a correction of some sort, which I think at a minimum, we'll see a 10% correction within the next few months, and it could be even sooner with earnings starting in the next couple of weeks.
Yeah, it's definitely looking quite toppy. So I guess you mentioned there's a few indicators that you're watching that haven't really lined up. Yeah, I'm not sure if you can maybe explain a little bit more. And then what are you really looking forward to see? I know it's hard to predict, but to see that okay, maybe it has rolled over at least for the short term. What are the things you're looking at?
Well, typically, as I do, I forgot your first question about a hard landing, and I think everybody, you could say it's going to be a hard landing, but the majority of people will say it's going to be a soft landing. That's usually what has happened over history. And if you go back and you scroll through old newspaper clippings and what Fed chairmen have said over other periods, it's always going to be a soft landing. It just turns into a hard landing. So some of the indicators that I use, I track market sentiment, and I use several of the sentiment polls that are out there. They're all very much stretched right now to the upside. And one of the things that's been different this year with market sentiment is it basically stayed fairly muted for most of the first half of the year. And just simply after the NVIDIA earnings report, it went parabolic. And that, I think, is a sign of basically a blow off top. I also am a specialist with DeMark indicators, and DeMark indicators have been around for decades, and they track exhaustion signals. So signals that I'm not going to get into it today because it would probably take a few hours or days. For me, it took years, but they track, levels of, when you can buy on the downside, and then sell on the upside. And I've used the indicators long enough to know when they're going to work most effectively. And I'll say that they have worked fine this year. But last year we had a lot of really good buying opportunities, and this has not been a year where we've been able to get really good opportunities to buy. I mean, that's, someone could say, well, Tommy should have just bought every day, and maybe that's true. But I'm starting to look at other places other than tech, and I am short tech right now. I didn't have gray hair to start the year, but now I do. No, that's actually not true. But the bottom line is things are getting stretched. Valuations are definitely getting stretched to the upside. We haven't seen price earnings ratios on some of the largest tech names at these levels in many, many years. And you can even go back perhaps decades to say when the last time Microsoft or Apple traded at some of the valuation levels that we're seeing now. And it's all about AI. And AI is something that people are fascinated with. And look, NVIDIA said that their earnings are going to be up substantially because of AI. They've also said that this similar things about the metaverse. It was going to be a $4 trillion business, and they were going to benefit from it. They have benefited apparently from crypto, from data centers, from everything. But I think a lot of things right now are being reclassified as AI, and that's fine. But now it's going to be, okay, put up or shut up and show me the earnings that translate to why your company should be valued at where it is. So I'm not skeptical about AI. I'm skeptical about the stocks that have, and the moves that they've had to continue the surge that they have. And we also have, I track a lot of different things. I look at short interest in the market, and I can say that you really don't have a lot of shorts that are involved in the market right now. I think you have more people that are on the sidelines that are getting, professional fund managers are getting forced into the market with the moves. And that's always scary. I look at Elliott waves, and one of the things that people, when they start hearing Elliott waves, their eyes gloss over and they get lost. But one of the things that it makes it very simple, you take away the nonsense of the Fibonacci levels and all that, because that's subjective. But what isn't is what really the personality of each wave. And to go back to December, we were in there's 5 waves, and we were in the last of 5 waves going down. So we turned higher, and that was the first wave. And the first wave is where nobody believes it. They think it's going to continue to go lower. And we saw a big move in January up, and that was the first wave. We pulled back briefly. made a higher low in wave two, where people were shorting into that, and then rebounded higher into wave three. And wave three is when people start to get on board and say, okay, well, maybe this is going to work this year. We're going to go higher. And we had a brief pause, which is wave four. It's another corrective wave down, but it didn't make a new low under wave two, and then moved higher. And in wave five, there's certain personalities in the market that are happening, and that's when let me think of all of them. First of all, you have broad participation. That's when the public finally starts to buy into things, and we've seen huge inflows into the market, and and possibly late, in my opinion. You see heavy call buying, and we've seen, the amount of call buying is almost identically identical on the opposite side to the put buying that we saw in December. So people are speculating. Market sentiment is extreme, and that's very true on really every sentiment poll you can look at, or even the internals. You're starting to see divergences occur where you'll see price go up, but momentum's not confirming it. And the last thing is that you see public mockery of anyone that is bearish in the market. And I will say that that is certainly true. If I go on Twitter, I certainly get my fair share of public mocking, but I've done this long enough. I was a partner at a $5 billion hedge fund, senior trader. I had my own portfolio. I'm launching a new hedge fund too, August 1st, which thrills me because I'm very good at short selling, and I feel like there's going to be a lot of really good, juicy opportunities to catch, the next move down. So that's kind of a lot in that answer, I think, right?
Yeah, there was plenty. So many questions to come out of that. So I guess, are you seeing that, you've mentioned these LA waves, and there's these different waves. Do you think, you mentioned wave five, do you think that's sort of like the peak, or it's hard to know? It could be sort of just
Well,
as,
it could go, here's the thing, it can go further than most people anticipate. And wave three and wave five are fairly, they're the big, push waves that can go on and on. But what I'm seeing, I'm getting close with some DeMark indicators that are starting to signal upside exhaustion. And one of the things that has been different this year than last year, and made it much more challenging, is I track and screen every day the number in each stock within the S&P 500 that has an exhaustion on the upside and downside. And I've found that to be difficult because not everything is participating on the upside. And even if you like, I did a study today looking at the S&P 500, and majority of stocks are up on the year. I think you have, it's like 300 versus 200, 300 up, 200 down, just roughly. But if you go back to the peak in February, you have more stocks still down from that February peak than up. So I think it's narrowed, the breadth is narrowed in the market, but it could start to widen out. And I'm looking for ideas that I think are going to be second half ideas. And I'm looking at energy, I'm looking at materials, financials. I'm not quite there yet, but they're starting to act better. But I think tech is going to, they have a very, very high bar. And the problem for me as a short is that you have, everybody wants to buy every dip, and you really are going to have to hear some horrendous news from them that they report that it's not quite all there. And let's just and I can kind of tell you that I think that just to go back to some economic stuff, I think the Fed is not done. I think the Fed will raise rates in July, and there's not a lot of people are talking about the CPI report. The inflation data is actually going to start to have easier comparisons versus last year, which could start to see that lift. And I've had two things on my mind. Either inflation is not going to come down fast and hard enough, or it's going to remain sticky and then possibly start to reaccelerate. And the Fed has a mandate to control inflation, and having the equity markets go higher is probably not in their best interest to for their mandate for what they want. And they need a recession to happen to really knock out inflation. And that seems like the waiting for Godot. Nobody's ever going to get a recession. It's never going to happen, but it will probably happen. I can't tell you when, but it's probably on the horizon. And considering the market's gone up so fast, so steep, I wouldn't be shocked to see some sort of significant break in the market. I don't want to use the C word that ends with ash, but it could happen. And if that happens, all the call buyers are going to get wiped out. You could see that really cause a recession. The 1987 crash really hit the economy hard, and other periods when the markets crashed. I'm saying it. Oh, said I wouldn't. It's been really tough for the economy, and I think that that's still a really big risk. And you have inflation that's really hurting people. It's causing people to spend more on the basic stuff. It's the housing markets are kind of frozen right now. That's difficult. And I don't think that there's really anything the Fed can do other than just continue to do what they need to do. And that's the hard part of the Fed's job. It's easier to cut rates, and that's highly unlikely, especially when they're doing QT and buying, and trying to reduce their balance sheet. It's not that effective. So they would have to do both. They would have to stop QT and cut rates together, because you can't do one or the other. It would be sort of counterintuitive. And I think if the Fed starts to cut rates, first of all, they're not going to cut rates if the equity market is going up like this. That would be meaningless. And it would have to take some serious dislocation in the markets for the Fed to do that. Now, we always talk about stocks, but I look at everything, and I'm looking at the bond market, and rates are going higher. And you're in the UK, and gilts are going higher. You have this problem with higher rates that the US equity market just sort of whistles by the graveyard, looking at rates higher, but it will start to impact the consumer, other companies that are trying to refi their debt, and that's probably a 2024 story.
Yeah, it's already been started talking about sort of mortgages in the UK, and can they bail out people, because there's obviously adjustable mortgage rates here. So it definitely seems like, as you said, it's more of a lagged effect on what's happening. Are there any other, I guess, macro drivers that you're currently watching, or is it mainly just the monetary sort of aspect of it?
Well, I've thought the dollar could continue higher, and it's been in sort of a narrow range with other crosses. So I think that's something to watch. The yen has weakened substantially, and that's been seemingly positive for equity markets. But I think that's coming to an end as well. I mean, they may just say, okay, whatever, throw caution to the wind, and let's just keep the weak yen. And Japan has had a different monetary policy other than every other central bank out there, and that could be someday a real story. But until that happens, we just get to watch.
Yeah, definitely, it makes sense. So you mentioned before that you're sort of looking to, I guess, or you think there'll be this transitioning or rotation between different sectors. So you're looking, I guess, the currently unloved sectors at the moment, the materials, the energy, I guess, other sort of staples. Are those the companies you think will benefit, I guess, if we were to see this downtrend in technology, and is there anything else that you're looking at as well?
Yeah, one thing, historically, energy stocks don't do well if we go into a recession and crude prices go lower. I just think that we've already seen a substantial drop in crude, and demand seems to be fairly steady around the world. And the Biden administration uh, has released their strategic petroleum reserve, this big, that's why the prices have gone down. But I think there's going to come a point where they're going to have to start to refill that. And for Joe Biden to walk into, the oil pits and say, I need to buy 200 million barrels of crude, that, he'd be walking in with like a post-it on his forehead, and just that would be a joke. Um, because I think that every oil trader would just buy oil and jam the price higher on them. So it's going to be tough for him to get that done. And you have OPEC, specifically Saudi Arabia, notably, that has been cutting production. So I think crude could have a floor. And on top of it, I think oil companies have learned their lessons over the last few decades of what to do before a recession and how to manage your business well. And I think that their balance sheets are great, most of them, and their businesses are being run really lean. So I think that that's a bigger picture place that the market could benefit. And if that happens, inflation will go higher as well. And last year, energy with inflation high, energy companies did pretty well.
Yeah, makes sense. And I guess the other sectors that you're watching as well was
I'm
a pretty
watching
big one.
materials, and copper prices and metals and industrial metals have come down a lot. I think that China's the only country right now that has signaled that they're going to start stimulating, and they have lots of means to be able to do that. Whether I mean, I look, China's a whole nother story, but if they do start to put in some stimulus measures, I think the industrial metals will do well. Copper has been beat down, and I think that could work. I'm looking at commodities too. I'm trying to find a place to buy grains such as wheat, corn, soybeans. I think that could work. There's a big drought in the middle of the U.S. right now, so I think corn prices could go up. Other commodities like agriculture could work, and that again, that doesn't help the CPI, the inflation data as well. So that's another risk. I mean, I'm really a lot of fun. I'm sure you probably have like people that say, "Oh, let's buy this, and you'll make all this sort of money." I'm sort of in the cautious mode. I mean, you should catch me when I turn bullish, because I mean on overall, because I do. I'm not always bearish, but I think people just need to have a very sober mindset right now, and not get carried away and look at the FOMO and the stuff that's already worked. I think you have to. I mean, I could never go on financial TV. Well, I do on Bloomberg, but I can never go on like a CNBC. And if you've ever seen it, they're always talking about what's working today. And I'm the type that I'm planting seeds in the ground, and I'm going to watch them grow rather than what the financial TV wants you to see is, they just talk about when people should be picking the fruit of mature trees. So I'm I try to be in front of things. And I think that right now there's more risk in the market than I've seen in a long, long time.
Yeah, I definitely agree. You've talked about, I guess, sort of the indicators you're using and what methods you're using to get to these ideas. Is there any other ways? Because I guess probably takes a lot of ideation and a lot of thinking to actually then put a position on from your perspective.
Yeah, it definitely it takes a lot for me to um, put things on. I mean, I trade U.S. equities primarily on the long short side, and I'll look for one of the things I do is I look for buy signals for DeMark indicators, and those are usually the ones that have just moved lower, and then I'll sell short ones that have upside exhaustion signals. One thing you can look at some of the most basic technical analysis tools that everybody can get, like an RSI, and a lot of those are getting extended to levels that I haven't seen in a while. And when they start to reverse down, you can put on a short position and play it that way. But I don't really have a lot of things that are super oversold. I was short gold miners recently, and I covered it 2 days ago, and that was I made 17% on the downside. And I'll tell you this, when I put the trade on, it was at the highs not too long ago, and I had people that were usually when I'm on Twitter and I'll say I'm doing something and it seems like a contrary idea, which I'm a contrarian. I have a lot of people that say good luck, like sarcastically. And when I get that, I know I'm gonna win on that. That's just my little thing I watch, and I'm like, yes, it's gonna work. And it did. And I don't really, I'm not there to fight with people on Twitter. I got a market that I'm battling with. That's more important for me right now.
Yeah, definitely. It's just listening to people's opinions, and some of them you can just throw away, but others are really interesting. So, yeah, Thomas, thanks so much for your time today. I appreciate it. I guess my last question is, what is one message you'd like people to take away from our conversation?
Well, again, I don't think people should get carried away, chasing things that have gone up substantially. I think you need to wait and pick your spots, do your work. One thing that I also stress to that for myself, the way I manage money, and for the work I do with hedge fund telemetry, I stress position sizing. And position sizing is vital, especially in this market, because I try to keep everything under 5% at inception. And by doing that, if I'm wrong by 10%, I'm down 50 basis points, and I can live to play another day. I'm not going to blow myself up. And I just want people to, stay in the game. And, I can demonstrate that I can do pretty well, even with small position sizes. If I buy 2% of something, I still feel I can make money with that and have a really good year. It's the people that gamble too much and put too much on one idea, and if it also causes like way too much anxiety. So that's one thing to, you don't need, it's just managing money. You don't need to have the anxiety of, having too big of a position, and most of the time you lose because you get shaken out too quick.
Yeah, I think that's a great message to take away. So, Thomas, thanks again. So, you mentioned Hedge Fund Telemetry. Is that the best place people can find your work? I know you're on Twitter as well.
Yep. Twitter, Tommy Thornton on Twitter, and hedgefundtelemetry.com. And if anybody wants a free trial, you can send me an email at info@hedgefundtelemetry.com, and I'll hook you up.
Perfect. I'll put that in the description below. So, thanks again for your time.
All right. Thanks.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.